Okay, so you want to own an airline. Buy some planes, sell some seats, watch the money fly in. Every seat on every flight sold for hundreds of dollars multiplied by hundreds of flights a day. That's the picture in your head. Walk through any major airport on a Friday evening and it looks like the easiest business in the world. Every gate is packed. Every flight is boarding. People are lined up paying real money just to sit in a chair for a few hours. You watch that scene and you think, this must be one of the most profitable businesses on earth. Here's the problem. You are looking at the one moment of the business that lies to you the most. The truth is that an airline is not really a transportation business. It is a business that sells a perishable product with almost no pricing floor, running on razor-thin margins, propped up by fuel bets, debt, and a seating chart engineered to squeeze every dollar out of 200 strangers sitting in the same metal tube. And once you understand that, it starts to make sense. Let's start with what it costs just to get a plane in the air. There isn't one type of airline. There are several, and each one is a different bet on the same underlying question. A full-service legacy carrier flies a wide network of routes, offers multiple cabin classes, and connects passengers through hub airports, usually operating on thin margins across an enormous fixed cost base. A low-cost carrier strips out almost everything. No assigned seats in some cases, no free bags, no free snacks, and makes its real money on fees layered on top of a cheap base fare. An ultra-low-cost carrier takes that even further, selling seats near or even below cost, and surviving purely on ancillary charges. And a regional carrier doesn't really compete with any of them. It exists to feed passengers into a larger airline's hub network, usually flying smaller aircraft under a contract that guarantees it gets paid regardless of how full the plane is, which sounds like a safe arrangement until fuel costs spike and the fixed payment from the contract no longer covers what it actually costs to operate the aircraft that day. Each of these is a different answer to the same question. Do you make your money from the ticket itself or from everything you can sell around the ticket? Now here's where the naive mental model breaks immediately. You think the biggest expense is the plane. It isn't, not in the way people assume. A new narrow-body aircraft, the kind used on most domestic routes, costs somewhere between $100 and $130 million at list price. A wide-body used for long-haul international routes can run $300 to $400 million. But almost nobody pays list price. Airlines negotiate steep discounts, sometimes 40 to 50% off, because manufacturers need the order volume just as much as the airline needs the plane. Even after the discount, a single wide-body jet can still cost close to $200 million, and an airline needs dozens, sometimes hundreds of them just to operate a meaningful network. Here's the decision that trips up almost everyone who models this business from the outside. Do you buy the plane outright or do you lease it? Buying feels safer on paper. You own a real asset that sits on your balance sheet. But buying drains a mountain of cash up front, right when you need flexibility the most, and aircraft don't hold their value the way people assume. Leasing sounds smarter. Smaller monthly payments, easier to swap out aircraft as fuel-efficient models come along, and no giant depreciating asset dragging down your balance sheet. But here's the catch. Lease payments don't care whether ticket sales are strong or weak that quarter. They are a fixed obligation, due every single month, and today more than half of the global commercial aircraft fleet is leased rather than owned outright. Whichever path an airline picks, it has just locked in a massive fixed cost that keeps arriving whether the planes are full or empty. Now, fuel. This is the cost that actually decides whether an airline has a good year or a terrible one, and it is almost entirely outside the airline's control. Jet fuel typically makes up somewhere between 20 and 30% of an airline's total operating costs, and that number swings wildly with global oil prices. A narrow-body aircraft can burn roughly 750 to 800 gallons of fuel per hour of flight. Scale that across a fleet of hundreds of aircraft flying thousands of hours a day, and a single dollar move in the price of oil per barrel can shift an airline's annual costs by tens of millions of dollars. Airlines try to manage this through fuel hedging, essentially locking in a future price today to protect against a spike. Done well, hedging can save an airline enormous sums during a price surge. Done badly, timed at the wrong moment in the cycle, it can lock an airline into paying far more than the market price for years, and several major carriers have taken multi-billion-dollar losses on exactly that mistake. Labor is the next enormous line item, and it is far less flexible than people assume. Pilots, flight attendants, mechanics, gate agents, and ground crew are almost entirely unionized at major carriers, which means wages, schedules, and staffing minimums are locked into multi-year contracts that the airline cannot simply cut when a bad quarter hits. Labor typically eats up another 25 to 35% of total operating costs. Combine labor and fuel, and you've already accounted for more than half of everything an airline spends before a single passenger has boarded a single flight. Airport costs are the layer almost nobody outside the industry thinks about. Airlines pay landing fees every single time a plane touches down, priced by the weight of the aircraft. They pay gate leasing fees to rent space at the terminal, sometimes for exclusive long-term rights at major hubs that can run into hundreds of millions of dollars over the life of the contract. They pay for ground handling, baggage systems, check-in counter space, and de-icing in winter markets. At a hub airport, these costs alone can run into the tens of millions of dollars a year for a single carrier. And none of it depends on how many seats actually sold. There's a maintenance cost buried in here that almost nobody outside the industry accounts for correctly. Aircraft don't just need routine servicing. They need what the industry calls heavy checks, deep structural inspections that happen every few years and can pull a single aircraft out of service for weeks at a time. A major heavy check on a wide-body aircraft can cost several $1 million by itself, and an airline running a fleet of a few hundred planes is essentially always running a rolling maintenance program somewhere across its fleet, every single week of the year. Engines are their own separate expense entirely, often owned or leased through a completely different contract than the airframe itself, and a single engine overhaul can run into the millions. None of this shows up in the glamorous part of owning an airline. It shows up quietly on a maintenance schedule that never stops. Then there's slot ownership, which sounds like a technicality until you understand what it actually controls. At the busiest airports in the world, there are only so many takeoff and landing windows available in a day, and those windows, called slots, are allocated to airlines under rules that can date back decades. A carrier that holds a strong portfolio of slots at a congested hub effectively holds a scarce asset that new competitors cannot simply buy their way into, regardless of how much capital they raise. This is part of why certain routes stay dominated by the same one or two carriers for years at a time. It isn't always about who runs the better airline. Sometimes it's about who already owns the window of time when passengers actually want to fly. So add up the aircraft financing, the fuel exposure, the labor contracts, the airport fees, and the maintenance schedule running quietly in the background, and even a mid-sized airline can be carrying billions of dollars in annual fixed and semi-fixed costs before it has earned a single dollar of ticket revenue. This is the part that explains everything else about how the business actually runs. Now let's talk about the seat, because this is where the business gets genuinely strange. Picture the same flight, 200 identical economy seats, all flying the exact same route at the exact same time. Now imagine that no two of those seats sold for the same price. Some passengers paid $90, some paid $400. Some paid $1,100 because they booked the day before departure. Same seat, same flight, wildly different prices, and every single one of those prices was calculated on purpose. This is called revenue management, and it is arguably the single most important department inside any airline, more important in many ways than the flight operations themselves. The system works by predicting, months in advance, how demand for a given flight will build over time, and then releasing seats at different price tiers as that demand materializes. Book early and the algorithm assumes you're price sensitive, so you get a cheaper fare. Book at the last minute and the algorithm assumes you have no flexibility, likely a business traveler, and prices you accordingly. The airline isn't guessing. It's running the same flight through years of historical data, adjusting in real time as seats sell faster or slower than the model expected. Here's the part that reframes the entire business. A flight's break-even point, called the load factor needed to cover costs, often sits somewhere around 75 to 80% of seats sold at blended average fares. Below that, the flight loses money. Above that, and this is the important part, almost every additional seat sold is close to pure profit because the fuel is already being burned, the crew is already being paid, and the plane is already in the air regardless of whether that last seat is empty or full. This is why airlines will sell a seat for barely more than the tax on it rather than fly with an empty seat. An empty seat generates zero revenue and vanishes the second the door closes. A seat sold for even $60 generates something. This single fact is why airline pricing looks chaotic to a passenger and looks perfectly rational to the airline. They are not trying to charge you a fair price. They are trying to fill every seat at the highest price each individual passenger is willing to pay before that seat becomes worthless forever. This is also why the industry leans so heavily on something most passengers don't think about at all: ancillary revenue. Checked bag fees, seat selection fees, priority boarding, in-flight food and Wi-Fi, and increasingly, fees just to change or cancel a booking. For a full-service carrier, these fees might add $10 to $20 of revenue per passenger. For an ultra-low-cost carrier, ancillary revenue can make up 30 to 40% or more of total revenue per passenger, sometimes exceeding the base ticket price itself. This is not an accident, it is the business model. The advertised base fare is deliberately priced low, almost as a loss leader, to win the search engine comparison against a competitor, and the real margin gets built back in fee by fee once the passenger has already committed to the booking. A traveler comparing prices across a handful of flight search sites will almost always click toward the lowest number on the screen, and an ultra-low-cost carrier is built specifically to win that first click, fully aware that the final price the passenger pays once bags, seat selection, and boarding priority are added back in will often land close to or sometimes above what a full-service carrier would have charged for the same route with everything already included. The unbundling isn't a mistake in the pricing model, it is the entire pricing model. There's a second, even larger revenue engine hiding in plain sight that most passengers never think about: loyalty programs. A frequent flyer program isn't really a customer appreciation gesture. It is, in financial terms, a bank. Airlines sell miles in bulk to co-branded credit card companies. Banks essentially pay the airline cash up front for the right to offer miles to their cardholders, and the airline then owes those miles out as future travel at some point down the road. For some major carriers, the loyalty program generates so much reliable cash flow that analysts have valued it, on its own, at more than the entire rest of the airline combined. During periods when actual flight operations were losing money, the loyalty program alone was often still profitable, which tells you something important about where the real value in this business quietly sits. Some airlines have even used their loyalty programs as collateral to raise emergency financing during a crisis, borrowing billions of dollars against the future value of miles that hadn't even been sold yet, which only makes sense once you realize the miles bank is often the single most predictable, recession-resistant part of the entire company. There's a seasonal rhythm to all of this that shapes an airline's entire financial calendar, similar in spirit to how a gym plans around its January surge. Summer travel and the holiday season around the end of the year typically produce the strongest demand and the highest fares of the entire year, while the weeks right after New Year and again in early autumn tend to be the softest, sometimes called shoulder season inside the industry. Airlines plan capacity, staffing, and fuel purchasing around this predictable curve, front-loading aircraft utilization into the peak months and often parking a portion of the fleet or reducing frequencies on weaker routes during the quiet stretches. The airlines that manage this well use the strong months to build cash reserves that carry them through the weak ones. The ones that treat a strong summer as the new permanent baseline are the ones that get caught short when autumn demand comes in exactly as soft as the historical pattern always predicted it would. Alliances add another layer that most passengers never think about, even though many of them fly through one without realizing it. Major airlines group themselves into global alliances, sharing frequent flyer benefits, coordinating schedules, and code-sharing flights, meaning one airline sells a ticket and markets it under its own name, while a partner airline actually operates the aircraft. This lets a carrier offer the appearance of a global route network far larger than the one it could ever operate on its own, without the enormous capital cost of buying more aircraft or opening more crew bases. The revenue from a codeshare seat gets split between the marketing airline and the operating airline under a negotiated formula, which means a single seat on a single flight can be quietly generating revenue for two different companies at once, each of which sees a slightly different number depending on the deal they signed years earlier. Now, the psychology of why passengers accept all of this. Part of it is genuine time pressure. Flights have fixed departure times that don't bend. Part of it is what economists call price discrimination, hiding behind operational complexity. The airline can charge a business traveler 4 times what it charges a leisure traveler for the identical seat and frame it as flexibility fees rather than a different price for the same product. And part of it is sheer lack of alternatives. On many routes, only 2 or 3 carriers compete at all, which limits how much competition can push prices down. The industry has learned that passengers will tolerate an enormous amount of unbundling and fee stacking as long as the headline number on the search results page stays low. Now let's talk about what can go catastrophically wrong, because airlines fail in a very specific, structural way. Take a look at what happened across the industry in 2020. It wasn't that people stopped wanting to fly forever. Demand didn't erode gradually. It fell off a cliff in a matter of weeks, and airlines were left holding an enormous fixed cost base. leased aircraft, labor contracts, airport gate commitments, with almost no revenue coming in to cover any of it. Several major global carriers filed for bankruptcy protection within months of each other, not because their business model was fundamentally broken, but because the model has almost no slack built into it for a demand shock. An airline's costs don't scale down quickly. You cannot unlease an aircraft overnight. You cannot instantly renegotiate a union contract. You cannot walk away from an airport gate agreement without massive penalties. When revenue disappears and costs stay largely fixed, the runway to insolvency is measured in months, not years. This has happened before, repeatedly, and it is not a coincidence. The airline industry has one of the worst cumulative profitability records of any major industry over the past several decades. Legendary investor Warren Buffett once pointed out that the entire history of commercial aviation, added up across every airline that has ever existed, had at various points produced a net loss for investors overall, despite carrying trillions of dollars of capital investment. Individual good years can be genuinely excellent, but the industry as a whole has a structural tendency to compete away its own profits, because when one airline cuts fares to fill seats, competitors are forced to match and the entire pricing advantage evaporates almost as fast as it appeared. There's a real case study worth walking through here, because it shows exactly how this structural weakness plays out over decades rather than months. For most of the 20th century, one particular airline was treated as the gold standard of international air travel. The carrier that essentially invented the modern long-haul passenger experience, flew the first jet-powered commercial routes across the Atlantic, and became a genuine cultural symbol of glamorous travel. On paper, it should have been unassailable. But over the following decades, a combination of deregulation opening its most profitable routes to new competition, a fuel price shock it hadn't hedged against, heavy debt taken on to keep expanding its fleet, and a fatal terrorist bombing that devastated bookings for years afterward, combined to erode a business that looked, from the outside, like it could never fail. It filed for bankruptcy and ceased operations entirely in 1991. The planes hadn't gotten worse. The service hadn't gotten worse. The fixed cost structure simply outran the revenue the business could reliably generate once enough of the external conditions turned against it at the same time. Cargo is worth mentioning too, because it's a revenue stream most passengers never think about at all. Every passenger aircraft has cargo holds beneath the passenger cabin that can carry freight completely separate from checked luggage, and airlines sell that belly space to shipping companies on top of whatever ticket revenue the flight generates. In ordinary years, this is a useful but secondary income stream. During the period when passenger demand collapsed almost overnight in 2020, cargo became, for some carriers, one of the only reliably profitable parts of the entire operation, since global shipping demand for medical supplies and e-commerce kept moving even while passenger cabins sat empty. It's a reminder that a modern airline isn't purely in the business of moving people. It's in the business of moving anything that fits in the aircraft and is worth paying to move. So how does an airline actually make money in plain mechanical terms once you strip away all of this? The core engine is simple. Total passenger revenue plus ancillary revenue plus loyalty program income minus fuel, labor, aircraft ownership costs, and airport fees. If a mid-sized airline has a quarterly fixed and semi-fixed cost base of $2 billion and its average all-in revenue per passenger, including fees, sits around $200, it needs roughly 10 million passengers that quarter just to break even. Below that, every flight is quietly subsidized by cash reserves. Above it, and this is the part that mirrors every other business in this genre, the marginal passenger beyond break-even is close to pure profit because the flight was going to happen anyway. Here's the volatility that comes right after that math. Load factors, fuel prices, and labor costs all move independently of each other, and none of them move in the airline's favor at the same time by coincidence. A strong summer travel season can be wiped out by a single quarter of elevated oil prices. A well-hedged fuel position can be undone by a labor dispute that grounds part of the fleet for weeks. And a single geopolitical event, a war, a pandemic, a major mechanical grounding of an aircraft model can remove double-digit percentages of available capacity overnight, which sounds disastrous but can actually push remaining fares higher because fewer seats are chasing the same demand. Consider what a single percentage point of load factor actually means at scale. On a mid-sized carrier flying a few thousand flights a day, moving the average load factor from 79% to 80% across the entire network for a full year can add tens of millions of dollars in additional revenue, almost all of it flowing straight to the bottom line because the cost of flying the plane barely changes whether it's 79 or 80% full. This is why airline executives obsess over load factor in a way that seems almost disproportionate to outsiders. A single point of load factor is worth more to the bottom line than almost any other lever the business has. which is exactly why the revenue management system exists in the first place, to fight for every fraction of a percentage point on every single flight, every single day. Let's put together the two versions of a single year, because this is where the real picture shows itself. In the optimistic scenario, fuel prices stay moderate, labor contracts are already settled and predictable, demand is strong across both leisure and business travel, and load factors run consistently above 85%. Under those conditions, a major airline can post net profit margins in the range of 8 to 12% on tens of billions of dollars in annual revenue, a genuinely strong outcome by the standards of this industry. In the realistic scenario, oil prices spike unexpectedly mid-year, a new labor contract raises costs across the entire workforce, a competitor starts an aggressive fare war on several key routes, and a weather-driven wave of cancellations forces the airline to pay compensation and rebooking costs across thousands of disrupted passengers. Under those conditions, that same airline can slide from a healthy double-digit margin into a single-digit margin, or into an outright quarterly loss, while the planes in the sky that same week still look completely full from the ground. The difference between those two outcomes across a single year can run into billions of dollars for a major global carrier, and almost none of it shows up as one dramatic headline event. It's a slightly higher fuel bill here, a slightly worse fare war there, a labor contract signed at the wrong point in the cycle, compounding quietly until the number at the bottom of the balance sheet looks nothing like what the pack departure board suggested. The planes still take off on time. The gates still fill with people wheeling suitcases toward the jet bridge. From the terminal floor, the good year and the bad year look almost identical. The difference only shows up months later, buried in a quarterly earnings report that most of those same passengers will never read. So if you ever find yourself dreaming about owning an airline, remember the one thing that actually decides whether you survive in this business. It was never about how many seats you can sell. It's about how well you can survive the seats you already promised to fly, whether or not a single one of them is full.